Well, thank you for joining us to today's weekly update. I'm JJ O'Hare, and let's get right into it. First and foremost, the Lakeshore Chinooks game. Please RSVP by next week. The event is actually on July 10th. It's a ton of fun. We were absolutely packed last year. We had a great time. Please feel free to come out and join us. Send us your questions, service at o'harewealth.com, 414-644-0060 if you want to text them in. And the big questions. I know people are talking about the Fed. The Fed seemed to be a little bit more dovish this week. They talked about the fact that inflation hasn't seemed to rear back its ugly head, and housing is sort of going the way that we talked about just a few weeks ago on this very broadcast. Additionally, the turmoil in Iran and the Middle East, just despite what's happened, oil prices have actually started to retreat a little bit, and the market seems to be handling the news overall very positively. So there weren't a lot of questions about that, even though we kind of expected some. The big question we want to answer is sort of a broader question. How often do you get 3-year double-digit returns? And the answer is you get them on occasion, but not that often. And I expect the reason that question's coming up is because we had two in a row, so now we are maybe in line for a third. This chart goes back 45 years. If you look here, last 45 years, nearly half a decade, there are really 3 times where you get double-digit returns. Right, the late 90s, you get that string of 5 in a row, which was just incredible. And then people remember it as one of the best investment periods in history, and it arguably was. And it was followed up by a pretty nasty period where we saw the S&P decline for 3 straight years. But additionally, where else do you get 3 double-digit year returns in a row? 2012, 2013, 2014. Right, 2013, people remember that as an up 30% year. It's a fantastic year in the market. When you look back, that was a pretty powerful year. And then the last time you get it is more recently. It was 19, 20, and 21. And of course, 2019, people forget, we declined 19% going into the end of that year, into 18. And we spent most of 20 actually digging ourselves out of that trough. And then we ended up 29% from the start, but most of the year we were actually under the old highs. Then 2020 happened and COVID hit and the market was wild, and obviously we went down very rapidly during that period. We recovered rapidly, and then 2021 the market continued to accelerate upward. 2022 was a very nasty year across the board. And 2023, yes, double-digit returns, but we never hit a new high in the S&P 500. We spent all year clawing back to the new clawing back to new highs. So we still weren't back to even. We still weren't back to even until 2024, and even then, most of the market, except for really just a few names at the top, which were a huge percentage of the market, most of the names had not returned back to their old highs, and we continue not to do so for most of 2024. And then this year, we've had a 19% correction, peak to trough, where we were initially. Then the Liberation Day hit. There was a lot of turmoil around that. We went down 19% from peak to trough, and we've steadily recovered since. And now the market is up basically 2% through yesterday, year to date. Does that bode for a double-digit year this year? Perhaps. When you're looking at the markets, one thing you are looking at is short-term trends, and you're also looking for long-term expectations. In the short term, when you get a slide downward that quickly and a recovery that quickly, it would not be surprising to see the market overshoot on the upside and recover even more of those things. A lot of the things that people were worried about just in April still exist, and they just seem to not be nearly the focus. So would the market overshoot on the upside? Of course it does. It tends to overshoot on the upside and the downside. But on a long run basis, what are you looking for? You're looking to pay good prices for stocks, and you're looking for them to grow their earnings. Traditionally, you pay about 17 times forward earnings for stocks, meaning you're paying $17 for an estimated $1 of return of earnings that year. Right now, the entire market is pricing at about 22 times earnings. We spent the last couple of years with very little earnings, but big multiple expansion, going from 17 times back to 22 times. So the companies weren't actually making a lot more money, but our expectations for them were making a lot more money. So we were willing to pay more for those dollars of earnings. Our estimation right now is at 22 times earnings. It's hard to expect further multiple expansion. I mean, the last time we had 22 times earnings in any real significant way, other than just the past couple of years, has really going back to the tech bubble. So are we going to see 25 times earnings, 30 times earnings? Our estimation is no. That's really hard to fathom. You need to see earnings growth, and earnings have still been relatively positive. But earnings this year are expected to grow about 9%. Next year, some estimations have it around 13. Nobody knows for sure. If that's the case, we might have a double-digit year. Our expectations wouldn't be that it would be a blowout 25, 30+% year this year, but we might be getting most of the returns here in sort of this overreach. We might be going up about 10% for the year and then kind of stay there as a holding pattern as we watch things matriculate and see the earnings actually come in. So, nobody knows for sure. On a long-term basis, we're still very positive about the market. On a short-term basis, what do we see from here? Yeah, the market's probably going to be positive this year, which was part of our expectation. But most of it's going to have to come from earnings, not from multiples. And if you want to talk a lot more about this, in just a few weeks here, we're going to have our quarterly chart party, which is where we do a deep dive and do a whole bunch of charts and a whole bunch of research and try to explain to you everything that we're looking at all at once. And actually, we're going to cover several of these topics during that period. But with that, I'm going to leave everybody. Last week for this recommendation, Salil Bloom's 5 Types of Wealth. Excellent read. Great summer reading. And if we don't see you, have a wonderful 4th of July, because we'll probably see the week after that. Thanks for joining us, everybody. We'll talk to you soon.